Hey, I'm Bill Baruch, president of Blue Line Capital, and I'm here with my analyst, Jannis Meindl, and we're introducing a new podcast called The Triple Play. Our goal is to give you a short and sweet outlook on the macro while introducing three stocks. We'll touch on two, and we'll cover one and more in depth. And our goal is to bring you this every single week. Let's hop right into it. Giannis, give us the macro backdrop real quick.
Yeah, thanks, Bill, for the nice intro here. Looking forward to do this each week. So I think we need to kick it off with the first phenomenon that all market participants have really been following, which is inflation. And one of the things that Jay Powell has been doing recently is really dissect inflation into three categories. The first being housing and real-time indicators of housing already rolling over, although the headline, shelter component and CPI will be somewhat sticky. Then the second part is wages, which he expects will continue to remain sticky, and we'll connect that to one stock in particular today. And the third component, which is goods, those are rolling over sharply. And there's this old saying that goes, there's never been a shortage that's not been followed with a glut. And that's what we're seeing right now. We do see that shipping rates have come down substantially, and it's really a question of wages and how tight the job market will remain, also connected to tomorrow's jobs report here.
Yeah, and that's the big thing here to kick off the new year this week. You got non-farm payroll on Friday, tomorrow. And listen, it's going to be a big number. Wages surged in November. Are they going to see it again here in December? I believe there's some real distortions here in the labor market. I've highlighted that in some of the things I've talked about in the Morning Express that I write, as well as the Midday Market Minute. At the end of the day, I mean, it's a very tight labor market. We saw JOLTS job openings this week come in much stronger than expected. And then October was revised higher. So this release here this week was on November. Between November and October, I think it was about 650,000 jobs more than expected between the 2 months. And then we moved into ADP this week, much stronger than expected, a hot number. That was a good glimpse on non-farm payrolls. I think it was like 235. They're looking for somewhere in the low 100s. And then initial jobless claims. That was came in much lower than expected at 205, the lowest level since September. So you got these three, a trio of real strong job numbers that came in. This leads to the non-farm payroll. Obviously, the equity markets, they didn't break down, but they were on their back foot to finish out Thursday. And it puts the Fed in a tough spot because, you know, if you look back to 2021, where was some of their mistakes was not tightening policy when they really should have. The economy was clearly heating up, but the unemployment rate remained elevated, and that held them back. I thought that we would saw a pivot from Powell at Jackson Hole back in 2021. He didn't do that, and then inflation really took off coming into 2022, and that's where we find ourselves. Are they going to make the same mistake because because the unemployment rate is remaining too low? And you said it with inflation. Inflation is clearly starting to come down right now, and I think it's going to stay consistently down, at least in the first half of this year. But we'll see what happens.
Yeah, and I think connecting the overall theme of monetary tightening to the idea that the consumer has been extremely healthy. And if we look at figures like Atlanta GDP now, nearly clocking in at 4%, there's no sign of recession here, although the street seems to be talking about recession only. So as we look into the year of 2023 here and into the back months, ultimately we'll see whether inflation can roll over fast enough for consumer spending to stay relatively elevated. I mean, across the corporate sector, really, nominal revenues have been real strong. We've not seen any sort of earnings recession just yet, and that's because economic activity is driven by consumers here, and we see that the deposit base by consumers is quite healthy. We see that wealth of consumers in general, especially in the upper quartiles of the income spectrum, is real healthy too. So maybe consumer spending is going to hold up, and that's going to drive economic activity here this year.
Yeah, and I think you had a couple good points here. First, the consumer spending. Listen, the holidays, they're not what they were a decade ago. People have and can buy goods and what they want 24/7 on demand, delivered to your doorstep, same day, maybe next day. And so the spending and that excitement that leads into the holidays is not the same. I think people are waiting for deals to come in January. Last year, 2022, January retail sales was a blowout number. I think we could see something similar this year where, you know, just sort of tepid holiday season that shows up in the January retail sales becomes a big number that's released in February after the Fed has already made a February decision for whether they're going to hike rates or not. And then, you know, another thing you talked about the earnings compression. Now, I think earnings is a really interesting thing to talk about here, because I was looking back at the GFC, the financial bubble, dot-com bubble, sorry, dot-com bubble collapse. We saw PE ratios compressed by about 35% from high to low. And if you look back at what we just saw in this last year, PE ratios, the forward PE ratios compressed about 33%. So we've already seen this compression, this very similar parallel compression to that dot-com bubble burst. And I think that's what we're looking at is more of a dot-com sort of this, just taking the wind out of the sails here on tech. And speaking of that, if is it earnings, the multiple is elevated for the S&P. I mean, some people are looking for them to come down. I think it was 16 or 17. We finished the year out. If you remove Amazon, because it could really be an Amazon problem. Amazon's the third largest stock in the S&P as well as the NASDAQ. If you remove Amazon, which is nearly a 70 forward multiple right now, and replace it with Apple, you're getting a multiple that drops about 1.6%. So you're bringing that down even more, down in the 15s on the forward multiple. So I think there's something here to really notice for all those people out there. You're hearing the street, as you noted, recession, earnings compression. That's all you hear out there. I don't think it needs to happen. I think we could be in store for a soft landing for all the reasons we just talked about.
Yeah, exactly. It always seems to be the thing that everybody's concerned with that exactly doesn't happen, and that could be one of those things. And I guess leading into the corporate landscape here, leading with Energy Transfer, a Dallas-based midstream operator, it's really been an energy glut story ever since the shale boom kicked off, and that really made energy not an asset a lot of portfolio managers wanted to hold. But as a result of poor returns, we ultimately saw that there was a lot of underinvestment from drillers to operators to service companies. All of them did not invest enough in fossil fuel drilling. And as a result, all these assets in the space are ultimately scarce assets. So now that we're looking forward a couple of years out here, the U.S. is going to increase LNG export capacity through 2026 by about 60%. And anybody who has the assets with which to transport that additional volume is going to earn a fee on that. And Energy Transfer is one of these stocks. The company is going to benefit, as all its peers will, from that additional volume flowing through its pipes. And as we could clearly see during the last quarter, volume trends are extremely strong. They transported about 4.6 million barrels of crude oil. That was record volume transported despite it coming off a crisis. So that, I think, remains a healthy landscape with low multiples still in the entire energy space.
Yeah, I think energy has a spot in your portfolio. I mean, this year, looking back to 2022, even through 2021, at Blue Line Capital, we constantly had 15 to 20% exposure of energy within our equity bucket, and really vastly outweighing what the S&P was. It had an energy of 2% to enter 2022. I think it finished about 4% or so. One of the things everybody talks about is crude going to continue lower? Is this a bear market in crude oil? Listen, I don't know if there's a floor in crude oil yet. I mean, we know that the White House wants to replenish the SPR. We know that $70 is a big level. Also, WTI, the high 70s, maybe in Brent, $80 in Brent. That OPEC has chirped up a bit. There's obviously clear concerns right now with China's growth, global growth, the new virus surge in China. But China is going to have a reopening. So I think once we sort of work through this here in the next month, maybe two, I think that we'll see a resurgence in crude oil. I think energy stocks, they right now, I mean, everybody wonders, okay, have energy stocks outperformed crude oil too much in 2022? And I don't think so. I mean, a consolidation maybe could be healthy here. And if that happens while crude rises, you're not going to see energy stocks drop. Maybe crude just outpaces the price of energy stocks. So what we have here is a chart showing energy stocks relative to crude oil. And you see here, and when crude outpaced these stocks through 2021, this was at the bottom. This was at a historical bottom of this relative comparison. And coming out of that, 2022 was the time for energy stocks to really shine. And so if we consolidate here, I think there's definitely more upside over the coming years in energy stocks relative to crude oil, not to mention them having a place in your portfolio with dividends. I mean, Energy Transfer was about a 9% dividend. So you're looking at stuff here that's very healthy in this environment. And then Energy Transfer relative to the energy sector in general, the XLE, it actually underperformed through the pandemic, through 2021. and sort of bottomed out through 2022. So, I mean, it's a very well-owned stock, and we own it through one of our Midstream mutual funds that we do own outside of our equity bucket. But I think you're seeing signs here that Energy Transfer is really bottoming out from a relative strength against its industry. So I'm pretty excited about a stock like this. I think it's got to be on your radar, and I think the energy sector has got to be on your radar in this year.
Yeah, absolutely. And I think the ultimate question is going to be, when is the market going to give a higher multiple to some of these stocks, given how cash flow rich they are? And speaking about cash flows and about structural trends, I think one of the stocks that we definitely have on our radar and in portfolios is Rockwell Automation, which is really starting to benefit from some of these secular tailwinds, including demographic challenges on the demographics front, the fact that maybe China is not going to be that manufacturing hub that it once was, and connecting it to the macro side, which we touched on earlier in this discussion, is that wages remaining to be sticky are going to be a core tailwind for Rockwell Automation as companies are going to continue to invest in automation trends. One of the really interesting factors that I noticed in the last earnings call that the company had was the idea that despite e-commerce spend slowing down from the consumer side, warehouses are continuing to optimize for efficiency. So they continue to invest in solutions that Rockwell Energy and its peers provide, despite the slowdown in demand. And I think that's a really healthy sign, especially in the context of Rockwell outperforming the S&P over the short term, but also when you look at broad capital allocation.
You're right. I mean, this thing has really. You're hitting all the big narratives on the head there. I think it's a stock that it's going to prevail in this new environment with automation, wages being sticky. I mean, you hear the wage battles from everything from Amazon warehouses to McDonald's. Automation is going to be key, and Rockwell's right, in front and center in this. The other thing I think I like too is the trailing 12 months multiple on this was 32, and I mean so. The forward is down at 24. So you've already seen, some of this, expensiveness, a little pricey come in. It is a little bit on ahead of its industry bit right now. But the fact that too, it's outperformed the S&P consistently throughout 2022. So since bottoming there, I think there's tremendous upside this year in a stock like this for the narratives because it's become cheaper already, but it's also outperformed relatively to the S&P.
Yeah, and although the market is, like you said, rewarding the stock with a relatively high multiple compared to the S&P, let's say, it's because it's a high quality asset. It's because there are these long-term structural tailwinds behind the stock. And again, speaking of structural tailwinds, I think one of the themes that we'll be monitoring is definitely AI. And one of the stocks to play the AI trend with is Nvidia. So we've seen some of the trends play out there, but we'll talk about more here.
Yeah. I think Nvidia is a great stock that it's a great conversation. I think it's a stock that has a place in your portfolio. Really, the question is to what size do you want the exposure to Nvidia and to chips in general. And the conversation I've been having with a lot of clients is not so much about Nvidia, but I think you can see textbooks really written about Micron in the future. I mean, what they've done, they've gotten ahead of this. I mean, they've written down all revenue expectations. Micron reported earnings 2 weeks ago, as the market was really kind of had lost some footing. And you would think a stock like that, in the environment that was taking place 2 weeks ago, they missed earnings expectations, they missed revenue expectations, but they already set the table for that months ago. So I think with where it is founding a little bit of floor at $50, and Micron specifically, but even in the call, the earnings call, the CEO noted that he hopes other semiconductor companies, other chip companies, they do the same. And if the following day, so Micron missed, the stock was down 3% to 4% overnight. It cut those losses in half by the end of the day, that trading day. But other stocks like Lam Research were down 7% or something that day. Nvidia was even hit a bit. I think they might have been down 4% or so that day. But he noted that, and I think if these chip companies are able to get ahead of this environment, I think they're laying the groundwork for a very strong first half of the year if this market turns. Because I think if the market does turn, it's going to turn because the Fed's going to cautiously pivot a little bit. I call it pause. They're going to pivot. Let's call it that. But if the Fed does pivot or pause. What's going to lead out of here? I think the chip's going to be a leader. I think some industrial is going to be a leader. I think that, obviously cyclicals can, but within this chip environment, what chips are going to do are going to lead, and it's going to have to be the ones that have already written down the revenue expectations, stocks like Micron and stocks like Nvidia.
Yeah, I agree. The companies that have gotten ahead of expectations, ahead of negative earnings revisions, are going to be the ones that can surprise on the upside first if we indeed see a soft landing. And I think one dynamic in particular with Nvidia is the fact that despite a lot of people that have paid attention to the slowdown in gaming as a result of excessive spending during during a work from home environment that a lot of people have been under, we see really strong trends still on the data center side. Nvidia has a GPU market share, which is really the backbone for all of gaming, but also for all of the AI models, which ultimately go into data centers. Nvidia has an 88% market share in that arena. Right behind Nvidia is AMD with about 8%. And so as spending dynamics continue to point north in that area, I think that Nvidia is going to continue to benefit. And two of the main customers in that segment are first AWS from Amazon, and then you have Microsoft Azure. Those two segments of Microsoft and Amazon are really the two key profit centers. So if you were Amazon and Microsoft, you would continue to spend in those areas where you can earn high margins, high revenues, and ultimately reap the rewards from ultra high revenue growth. So there's no real reason why some of these companies would pull back on spending, especially in the cloud sector, and they will continue to put money into data centers, and Nvidia will be a key beneficiary.
Yeah, and you mentioned gaming. There was note I saw that from gaming, the Call of Duty release garnered $800 million in the opening weekend debut, surpassing Top Gun Maverick and Doctor Strange on their opening weekends combined. So I mean, the demand is there. Esports, is going to continue to be a positive trend. Nvidia added 20 million gamers in 2022, 100 million gamers since 2019. So the trend is there. I mean, I think gaming, as you noted, coming out of the work from home environment, definitely took a hit. There's a lot of pessimism around the gaming sector right now, but I love seeing pessimism potentially become a counter trend trade there, in the fact that it's going to really pick up in the future. So I mean, talking about Micron and Nvidia as well, relative to the chip sector, I mean, I think we saw a tremendous outperformance by Nvidia against the chip sector in general. From that, you got the slide up there. From that December. I mean, Nvidia was gained something like 40% from its off its low. Massive move in that market, or in that stock, but it also outpaced the chip sector in general. I think there's a really interesting setup here technically. If this holds over the next week or two, I mean, I think that really could bring some tailwinds to Nvidia. It's inverse head and shoulders on a technical pattern from both the stock itself as well as Nvidia relative to the SOX ETF SOXX. So I mean, I'm pretty upbeat on the stock. I think it has a place in your portfolio. We tend to own it, in weight, potentially maybe a little overweight at times. And the reason, obviously, we're pretty flexible in hedging downside, using Q's puts to hedge downside and do something like that. But I think it has a place in your portfolio, especially, again, I'll say it again, is if we're going to have a soft landing, I mean, chips are going to be a part of this rally in the equity market that takes hold. And I'm pretty upbeat on what the S&P could do in 2023.
Yeah, semis are cyclical assets. So if we indeed going to see a soft landing, I mean, we led with the idea that consumer spending continues to remain healthy, that economic activity writ large is quite elevated. So if the Fed can get to a point where maybe some of these wage pressures subside and they can pause and potentially pivot late in the year, then definitely chips are going to be some of the leaders here leading out of this.
Terrific. Well, Jannis, this was, I think, a successful first launch here of the Triple Play podcast. And for you listeners out there, thanks a lot for joining us. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.